Soft Currency Economics by Warren Mosler. Fiat money. Historically, there have been three categories of money: commodity, credit, and fiat. Commodity money consists of some durable metal of intrinsic value, typically gold or silver coin, which has some value other than as a medium of exchange. Gold and silver have industrial uses as well as aesthetic value as jewelry. Credit money refers to the liability of some individual or firm, usually a checkable bank deposit. Fiat money is a tax credit, not backed by any tangible asset. In 1971, the Nixon administration abandoned the gold standard and adopted a fiat monetary system, substantially altering what looked like the same currency. Under a fiat monetary system, money is an accepted medium of exchange only because the government requires it for tax payments. Government fiat money necessarily means that federal spending need not be based on revenue. The federal government has no more money at its disposal when the federal budget is in surplus than when the budget is in deficit. Total federal expense is whatever the federal government chooses it to be. There is no inherent financial limit. The amount of federal spending, taxing, and borrowing influence inflation, interest rates, capital formation, and other real economic phenomena. But the amount of money available to the federal government is independent of tax revenues and independent of federal debt. Consequently, the concept of a federal trust fund under a fiat monetary system is an anachronism. The government is no more able to spend money when there is a trust fund than when no such fund exists. The only financial constraints under a fiat monetary system are self-imposed. The concept of fiat money can be illuminated by a simple model. Assume a world of a parent and several children. One day, the parent announces that the children may earn business cards by completing various household chores. At this point, the children won't care a bit about accumulating their parents' business cards because the cards are virtually worthless. But when the parent also announces that any child who wants to eat and live in the house must pay the parent, say, 200 business cards each month, the cards are instantly given value and chores begin to get done. Value has been given to the business cards by requiring them to be used to fulfill a tax obligation. Taxes function to create the demand for federal expenditures of fiat money, not to raise revenue per se. In fact, a tax will create a demand for at least that amount of federal spending. A balanced budget is, from inception, the minimum that can be spent without a continuous deflation. The children will likely desire to earn a few more cards than they need for the immediate tax bill, so the parent can expect to run a deficit as a matter of course. To illustrate the nature of federal debt under a fiat monetary system, the model of family currency can be taken a step further. Suppose the parent offers to pay overnight interest on the outstanding business cards, payable in more business cards. The children might want to hold on to some cards to use them among themselves for convenience. Extra cards not needed overnight for inter-sibling transactions would probably be deposited with the parent. That is, the parent would have borrowed back some of the business cards from the children. The business card deposits are the national debt that the parent owes. The reason for the borrowing is to support a minimum overnight lending rate by giving the holders of the business cards a place to earn interest. The parent might decide to support a high rate of interest to encourage saving. Conversely, a low rate may discourage saving. In any case, the amount of cards lent to the parent each night will generally equal the number of cards the parent has spent, but not taxed, the parent's deficit. Notice that the parent is not borrowing to fund expenditures and that offering to pay interest, funding the deficit, does not reduce the wealth measured by the number of cards of each child. In the U.S., the 12 members of the Federal Open Market Committee decide on the overnight interest rate. That, along with what Congress decides to spend, tax, and borrow, that is, pay interest on the untaxed spending, determines the value of the money and, in general, regulates the economy. Federal borrowing and taxation were once part of the process of managing the Treasury's gold reserves. Unfortunately, discussions about monetary economics and the U.S. banking system still rely on many of the relationships observed and understood during the time when the U.S. monetary regime operated under a gold standard, a system in which arguably the government was required to tax or borrow sufficient revenue to fund government spending. Some of the old models are still useful in accurately explaining the mechanics of the banking system. Others have outlived their usefulness and have led to misleading constructs. Two such vestiges of the gold standard are the role of bank reserves, including the money multiplier and the concept of monetization. An examination of the workings of the market for bank reserves reveals the essential concepts. Additional monetary history and a more detailed explanation is provided in the appendix.